Hello everybody. In the current affairs this week, the week ended 7th of December 2025. On 5th of December this week, the Reserve Bank of India in its monetary policy reduced the policy rate, which is the repo rate, by 25 basis point. So now the repo rate stands at 5.25%. Repo rate is the rate at which the Reserve Bank would lend to the commercial banks, and in turn the commercial banks can lend to the end consumer. So any reduction in the interest rates by the Reserve Bank of India in its repo rate would sooner or later lead to a reduction in the interest rates for lending by the banks to its customers. The Reserve Bank of India could take this measure on account of two very favorable macro factors which India is into as of now. The first one being that the Indian economy is growing at 7.5% per annum despite whatever is happening globally. And the second one, important, is that inflation is in the cap of less than 2%. So these two were the factors which propelled the Reserve Bank of India to reduce the interest rate. This would definitely and naturally lead to the lower cost of borrowing for the customers and the corporates who are investing into may it be anything, may it be consumer goods, may it be real estate, or for corporates in their expansion and building the infrastructure. So this 0.25% decline will definitely be positive. Now the next monetary policy will be in February 2026. It is expected that if the inflation remains at this level of sub 2%, then there could be another decline of 0.25% even in February 2026 monetary policy. But this has an impact on the traditional saving instruments by people in India, it being the fixed deposits and fixed income instruments. There, the moment there is a reduction in the interest rate, the interest paid on these deposits also decline by, say in this case, 25 basis point, maybe not immediately, but definitely over a little period of time. So this can make equity oriented investments a little more attractive for savers, because reduced interest rates would lead to reduced incomes for them. As far as the Indian equity market is concerned, Nifty 50 was by and large unchanged this week. Nifty mid cap was down by 0.84%. Nifty small cap was down by 1.42%. FIIs continued to be sellers of more than 10,400 crores of Indian equities, but DIIs continued to be buyers to the extent of 19,700 crores of Indian equities. The best performing sector this week on the stock market was Nifty IT, which was up by 3.5% in just 1 week in a market which was either stagnant or on a little decline. On the commodity front, Brent crude was up by 0.87%, gold in India was up by 1.5%, but silver in India jumped significantly by more than 8.5%. On the foreign exchange front, this week the US dollar to Indian rupee crossed a mark of 90. So now the US dollar would be 90 rupees to $1. This is a psychological mark, and this is a sharp depreciation of 5.8% just in the year 2025. There are a few reasons why this happened. The foreign institutional investors, as we all hear every week, that they are sellers in the Indian market, and this year they have sold this year till date, they have sold Indian equities of more than 18 billion US dollars. Moreover, the high trade deficit which India is right now running is also one of the factors for the strengthening of the US dollar vis-a-vis the Indian rupee. The trade deficit was on account of gold imports which tripled in the recent times. Moreover, the exports were down by 12% year-on-year basis. The another psychological reason, and maybe to a certain extent, even the factor which is playing, is the rather breakdown of US trade negotiations, and that has also led to the strengthening of the US dollar vis-a-vis the Indian rupee. In the year 2026, Bank of America and ANZ Bank are expecting that $1 US will be around 86 rupees, and that is the kind of equation which is expected by them. But there are other observers who feel that the US dollar would be around 91 rupees to a dollar in the year 2026. Nasdaq was in the positive terrain by around 1%, and S&P 500 was mildly positive. MSCI China was mildly negative. This year to date, MSCI China has delivered a return of more than 36%, but still the price earning ratio of MSCI China is just 13.8. That is all for this week. Thank you.